Every year, someone asks the same question: bonds or FD? Which one should I actually put my money in? And every year, the answer people give is too simple: FD is safe, bonds are risky, done. That's not wrong, but it's incomplete, especially in 2026. Right now, we are at a specific point in the interest rate cycle that actually changes this comparison. Today, I'll walk you through exactly where FD and bond rates stand in 2026, where each one wins, and how to think about which one deserves your money right now. Let's start with the number most people already know roughly, but not precisely. As of mid 2026, most major bank FDs are paying in the range of 6% to 7.5% for general customers on 1 to 5 year tenures, with senior citizens typically getting an extra 0.5% on top. Public sector banks tend to sit at the lower end of that range, while private banks are a bit more competitive. If you're willing to go to small finance banks, rates run noticeably higher. Several are offering 8% to 8.6% on select tenures. The trade off there is obvious. Small finance banks carry more credit risk than a large public or private bank, even though deposits are insured up to 5 lakh rupees under DICGC either way. Now, here's the part that changes year to year: the RBI's repo rate. As of mid 2026, the repo rate sits at 5.25% after the RBI cut rates by a total of 50 basis points earlier in the year. The 10-year government security yield is currently around 6.9%. This is the benchmark every other bond gets priced against. Corporate bonds price themselves as GSEC yield plus a credit spread, extra return for taking on default risk that a government bond doesn't carry. In 2026, that spread means top rated PSU and AAA corporate bonds are yielding roughly 7% to 8%, while lower investment grade bonds, think BBB-rated, can push past 13% for those willing to take on meaningfully more risk. Worth a specific call out here: if you go through a SEBI-regulated online bond platform rather than a bank, you'll typically see a listed range of roughly 9% to 13.5% in fixed returns across the available bonds, a wider and generally higher band than what a bank FD offers, precisely because these platforms list a mix of ratings from AA down into the BBB range, not just the safest top tier bonds. So, the honest headline comparison right now: a safe top rated bond is roughly matching or slightly beating a bank FD. It's only once you move into lower rated corporate bonds, the kind populating that 9 to 13.5% platform range, that the yield gap versus FD becomes large. And that's exactly where the risk gap gets large too. Here's the part most FD only investors miss entirely: an FD rate is locked the day you open it, no more, no less, for the full tenure. A bond's yield moves with the market even after you buy it, and that has a real consequence. When interest rates fall, the price of bonds you already hold tends to rise. Update as of the August 2026 MPC meeting: the RBI held the repo rate steady at 5.25% for a fourth straight meeting, maintaining a neutral stance amid inflation running slightly above target and global uncertainty. So the rate cut momentum from earlier in the year has paused for now. The next meeting to watch is October 5th to 7th, 2026. If cuts resume then, bonds bought at today's yields could see meaningful price appreciation on top of their coupon if you choose to sell before maturity. An FD can never do this. It just sits at its fixed rate until maturity. Full stop. This is really the core argument for locking into bonds during a period like this one. You're not just capturing today's yield, you're also positioning for a possible gain if and when rates start falling again. Taxation is where a lot of the real difference hides. FD interest is added to your income and taxed at your full income slab rate every single year, whether or not you touch the money. There's no way around this. Bonds, depending on structure, can be more tax efficient. If you hold a bond and sell it after a year for a capital gain, that's taxed under capital gains rules rather than your income slab, which for someone in a high tax bracket can meaningfully change your effective post tax return. This is a big reason bonds tend to appeal more to investors in the 30% tax slab than to someone in a lower bracket where the FD versus bond gap narrows quite a bit after tax. One more practical point that applies to both: if your total income is below the taxable threshold, or you're a senior citizen eligible under the relevant limits, submitting Form 15G or 15H for senior citizens to your bank or bond platform stops TDS from being deducted at source in the first place, rather than deducting it and forcing you to claim it back when you file your return. Let's be fair to the FD side too. An FD from a large bank is about as close to zero risk as an investment gets in India, insured up to 5 lakh rupees with a known payout on a known date. Premature withdrawal usually just costs you a small penalty, a mild inconvenience, not a loss of principal. Bonds don't offer that same guarantee. If you need to exit a bond before maturity, you are selling into whatever the market price is that day. And if rates have moved against you, that price could be lower than what you paid. Lower rated corporate bonds also carry real default risk that a bank FD from a large institution essentially doesn't. FDs win decisively on simplicity, predictability, and liquidity at par value. Here's the practical framework for 2026 specifically. If you want zero complexity and guaranteed predictable payouts, and you're not in a high tax bracket, a bank FD remains completely reasonable. There's no shame in simple. If you're in a higher tax bracket, comfortable holding to maturity or trading through a demat account, and want to capture both a competitive yield and potential price appreciation if rates fall further, high quality government or AAA corporate bonds currently offer a real edge over FDs at similar or better safety. If you're chasing the 13% plus yields on lower rated corporate bonds, understand exactly what you're buying. That yield exists because the market is pricing in real default risk. This isn't an FD substitute. Treat it as a separate, smaller, higher risk allocation, not your core safe money. Quick recap. In 2026, FDs are paying roughly 6% to 7.5% at major banks, up to 8.6% at small finance banks. Top rated bonds are yielding a comparable 7% to 8%, with the added possibility of price gains if the RBI keeps cutting rates. Bonds also tend to be more tax efficient for higher income investors. FDs still win on simplicity and guaranteed liquidity. The honest answer isn't pick one. It's use FDs for your zero risk, don't think about it money, and use high quality bonds for the portion of your portfolio where you're comfortable trading a small amount of certainty for better after tax risk adjusted returns. If you want a deeper breakdown of how to actually evaluate a specific bond before buying it, check out the last video, link in the description. Subscribe for more no fluff breakdowns of what's actually happening in Indian markets.